So in this video, we're going to be talking about creating a $10 million business versus buying a $10 million business. And this is going to be a critical analysis, analyzing the time that it involves, the resources that it involves, and the amount of effort that involves in creating a $10 million business versus buying a $10 million business. You know, I was reading The Art of War a few days ago, and Sun Tzu, who is the author of the book, he said that before going to a war, you must always estimate the cost of fighting that war. And this is not just in the case of war, but even in business decisions, especially when you are taking a decision for your life. You have to anticipate what will be the time cost, what will be the financial cost, because time is life. You're giving your life away to create something that's important to you. So when you decide, okay, I don't want to be at this job anymore, I don't want to work for someone else, I want to work for myself, then you're faced with two choices. You can create a business from scratch, and you can buy a business. So we're going to look at the critical analysis between both these scenarios, because these are the crossroads that you will find yourself in the moment you decide, I want to be an entrepreneur. Okay, so I'm going to get into this right now. If you're new to this channel, hit that subscribe button. I post one video every single day, and it's all on business, finance, and entrepreneurship. So now, let's look at starting a company. When you're starting a company, you're just creating an idea. It's just an idea. Okay, first step to starting a company is obviously find the audience that needs a product or a service, the need in the market. Once you've identified the market and its needs, then you have to go and develop products and services to serve that market. And then you have to hire employees who can produce the products and services, and then you have to deliver. So you have to put in a lot of work beforehand, before you start the company, just to be able to make some profit. Okay, and this takes a lot of time, a lot of effort, a lot of resources on the part of the founder who's driving the venture. Okay, and there is a significant amount of time that's spent in creating these products and services. So, for example, if you want to create a $10 million business, it can take a lifetime. It can take a decade or 2 decades to do that. I have met people, very successful businessmen, who drive Rolls Royces in UAE. And I have negotiated with them to buy their business. And they have been doing it 17 years in a profitable sector, and working every single day without fail. They are at their offices. And still, that business is not worth $10 million. And the business that I am talking about, where the owner was driving a Rolls Royce and wearing a $200,000 watch, that was just a $3.5 to $4 million business. And he sat down with me and he told me, Prithvi, one of my biggest regrets in life is that I didn't do something big. Now, this is a multi-millionaire, a very, very successful individual. And he said, one of my regrets is that I didn't achieve something big. I didn't go after the big goals. And I see the team that you are building, I see your vision, and I see what you're doing. And it's really big. You want to create a $1 billion company. And it's something that I did not even think about. So it took almost his whole life to create this multi-million-dollar business. And it takes a lot of time. It's time intensive, it's capital intensive, because you're trying to create value out of nothing. You have nothing. You have a piece of paper and you're going to develop products and services. You're going to find the market that needs it and you're going to then sell it, and then you're going to get some money. Whatever money you get, after paying a little bit of your expenses, you have to roll that money back into the business to grow it. And then, maybe that money will come back, maybe it will not come back. So it's extremely risky because A, you don't have a reputation when you're starting off. You have very little capital of your own, and you're putting in all the time and you're getting exhausted, and it's just not working at the beginning. Very rare cases an entrepreneur starts a company and it becomes a success. You have to, in most cases, you have to have many business failures. And with each failure, you learn something. But with each failure, you lose time and money. And this is the reason you see so many people becoming multimillionaires and making a lot of money at 60, at 70. And that's the sad story, that they worked their whole lives to create this. And they have lost a lot on the way. They have lost money, they have lost time, and they have lost a lot of resources because mistakes cost money. And even then, it may or may not become a multi-million-dollar business. You may give up, you may decide that you want to do a job, you may do something small, or you may go get a job, make some more money and try again. There are many ways of doing it. But starting a company and scaling it to, let's say, a $10 million is going to be extremely, extremely challenging. Okay? Now, let's take another scenario. What if I told you that you could buy a business that's already creating $10 million? And you could buy a $10 million in 10 to 12 months. Even a $100 million business you can buy in 10 to 12 months. If you look at major mergers and acquisitions, M&A deals, they get concluded within 10 to 12 months. And that's how long it takes to buy something, that big. But if you want to create the same thing, it takes decades to do it. And it may or may not happen. So the odds of success in scenario one is low. There is a lot of effort. There's a lot of risk. You have to put in your own capital, your own money into this thing. And it may or may not work. And especially when you're working full time, you don't have anything else. You're just building this. On another hand, to buy a business that somebody else built, they gave their whole life. Even the profits that came from the business, they put it back. Maybe they assumed debt to build this company. And it's now big, it's now strong, it has a reputation, it has a customer base, it has services and products that are working, that are in high demand. And let's assume it's in an industry which is stable, for example, healthcare. And this is a ready business. And especially a business that is worth $10 million was, assuming it's $10 million, it's been created over decades. So naturally, if it took the owner decades to build it, he has to be in his 60s and 70s. And he wants to retire. What's going to happen to the business after he is gone? Maybe the children of his children don't want to take the business ahead. Maybe they want to do something else. So this owner, 70 years old, who's thinking, I spent my whole life building this business. It's my legacy. Who's going to take it forward? And how long am I going to work on this thing? I have money, thankfully. I built this business. I've been pulling some money out. And I'm secure financially, but I want to exit now. I'm tired. I want to spend time with my son. I want to spend time with my daughter. I want to spend time with my grandkids. I've worked all my life. And these guys, they want to exit their business. And this is the time where you can acquire the value that has taken 30 years, 25 years, 20 years to create. Imagine trying to compete with a business that was built over 25 years. In the same industry, in the same market, in the same region. You are going to be fighting against a big monster. You will be the underdog. And as glorious as it might seem to be an underdog, in the movies you see a amateur football team that beats the pros. In reality, it's extremely difficult. And it's extremely painful. And you have only one life. So, to start a company, it's very difficult to build it. It's very difficult to get financing. So a bank is not going to give you a loan to start a company. Okay. Maybe it will give you a small amount, but not a lot. And it will give you the loan based on your income statement. So if you have already making a lot of money, then yes, you will get the loan. But if you're not making a lot of money, you just have a small salary, the bank is not going to give you a big loan. And it's extremely risky to get a loan from a bank and start a company, which is really a test shot. Starting a company is just a test. You don't know at the beginning whether you will succeed or not. What evidence do you have? But if you buy a business, on the first day, you can ask the person, show me how much money you're making. And you can look at the 10-year track record. You can look at the whole past of the company, how much they have produced, and you can evaluate what the value of the business is. It's very straightforward. It's data-driven. There's more certainty to buy the business, and you are acquiring value. There is nothing that needs to be created. It's already created. It's producing money, and it's just, you just have to manage it. And it already has employees. It already has products and services. It already has a base of customers that are coming in that business regularly. Here, you have no customers. You have to get customers through marketing, which costs money and time. You have to develop products and services, which costs money and time. You will need employees, which costs money and time. And there is no financing. The financing is available with great difficulty. And you have to give up a lot of control in your company to bring money from investors. So this is the reason why most people are paralyzed before starting a business. And they should be. They should be paralyzed. They should not feel confident. People sometimes, wonder, what do I do? How do I be confident? You should not be confident. You should doubt yourself when you're doing something like this. You should have second thoughts. You should have the fear. It is something that is risky. So there is no reason to feel confident and powerful when actually there is no power there. So that's really the point that I learned, because I decided I don't want to work for anybody. I want to start my own company. And I had two options. I didn't even know how to buy a business, how to find a business, how to negotiate a deal, how to raise money to buy a business. I was just here. This is all that I had seen, people trying to start a business, and that's why so few succeed. Because the cost is high, it's high risk, and there is very few financial institutions that would finance this. People have existed before you. There were people that exist before you that gave their lives to build a business. They put in time, money, resources, everything. Now you are born and you want to put in your whole life to create a business? Or are you going to be smart and wise and buy the business that somebody else created? They will sell it to you. It's going to take much less time and money to buy a $10 million business instead of creating one. To create the $10 million revenue in the last 20 years, the person could have spent around $50 million. Whatever profit come in, they reinvest, and then they reinvest, and then they reinvest. They keep reinvesting the profits, and then they keep some, money for themselves. But it takes a lot of money to create a stable income, a stable, or revenue of $10 million. They could have spent a lot of money doing that. So people have existed before you. They have created businesses. You can go in and you can buy them. But you may say, I don't have the money to buy, And let me tell you something. People who do billion-dollar deals, $100 million deals, do you think that they are writing a check from their personal account to buy these things? Do you think when someone buys a $200 million real estate property, do you think in most scenarios they write a check from their personal account, or they get bank financing and they pay over time? And they can rent that house, generate income, and pay from that. So you do not have to have your own money to buy these businesses. You can raise capital from the banks. And especially if the business is producing high profit margin, good revenue, stable employees, good customer base, good reputation, an old owner. And because the owner is old, you pay a low purchase price, discounted purchase price. So the business is big, it's profitable, but you're buying at a cheaper price. That is music to a bank's ear. Because whatever loan amount you take from the bank to buy this business, you can structure it over 5 to 7 years. So you can take this purchase price and structure it over 5 to 7 years. And how do you pay the bank back their money? By running the business. It's generating cash. Remember, you can use this cash that it's generating and pay off the loan with interest. But how do you know you will be able to pay off the loan? Well, you have the financial statements to see if this amount of loan can be paid in 5 years, 5 to 7 years or not. If the balance sheet or an income statement of the business is not able to pay off the loan, you got to reduce the price or walk away from the deal. But if you see clearly that this income can clearly cover the debt in 5 to 7 years, in fact, very comfortably, it can cover the debt payments. And even after paying the debt payments, you will still have some cash for you and to pay yourself a salary. It's a straight over, and that's exactly what a deal is called. A deal is when you can buy something at a low cost that's producing cash flow, and you can get financing from the bank. And the business pays, the income from the business pays the bank. And that's an M&A transaction. The other thing to understand is that the loan is not going to be in your name. For example, me, Prithvi, is not going to take the loan. The company that I form, the company will be the borrower. The clinic or the healthcare company that I acquire, that would be the borrower. The loan will be in their books. and the loan would be collateralized with the bank through that company. So I'll give you an example. There is a very famous private equity firm called KKR. It started with $200,000 and it has grown to now, I think, $300 billion. And the main strategy that they used, they did not create the business from scratch. They just went and started acquiring these big companies. And they would raise the money. They didn't have money of their own. Eventually they did, but at the beginning they didn't. And they did big acquisition, $8 billion deal, $10 billion deal. I mean, big transactions. And they would get a loan from multiple banks and acquire giant companies. So how does the loan get collateralized? Who's going to collateralize the loan? Well, the company has machines. The company has buildings. The companies used to have private jets. The company had, the whole infrastructure, assets. The company had a bunch of cash reserves. So it has all of this stuff that's actually the production line that's producing all of this money. They would collateralize the whole company and get financing. And these types of financing were called non-recourse loans or covenant-like loans, which just means that they are not personally liable if anything happens to the company. The company will be taken over by the bank, and the bank will have to sell the assets of the company. So that's what's possible. That's what these guys made possible. They went and they bought these companies. And these companies took, 40, 50 years to create. If you heard about Oreo, cookies, Camel, they were all owned by one company, Nabisco. It was a big conglomerate. It was a monopoly. And they went and they acquired it using debt and some other forms of financing. But the bottom line was that they raised the money to buy this company. They negotiated the purchase price, negotiated the terms. They went to the bank, showed them the term sheet, got the money, and acquired the company. And it happened to be a great acquisition. They did good things with it. They made it more profitable, better, and they acquired another one. And that's how they became really, really big. And then they took this company public in the stock exchange market. When you take a giant company public, you bring in a lot of capital in. From that capital, you do more acquisitions and you keep becoming bigger. And this is the game of mergers and acquisitions. This is the game of buying businesses. And it's far more efficient and less risky. Of course, there's going to be risk. It depends on the deal structure. It depends who's advising you. It depends what types of business you acquire. It depends, what's the interest rate like. It depends several factors within the business that you are acquiring that you have to analyze. And you need to have a team who will do this analysis with you and help you from their experience. And help you identify which companies are good to buy and which companies are not good to buy. So those are the disadvantages of starting a company. Now, talking about some disadvantages of buying a business. First disadvantage is that you don't know how to run this company. Okay, maybe you don't have the experience of running this company. So what? You can find that company will have enough cash flow for you to find someone, a CEO, a COO, Chief Operating Officer, Chief Executive Officer, from a very well-known, for example, if it's a healthcare company, you can get a person who has run these companies for 25, 30 years. And you can pay them a nice salary and they will help you manage the company. So the disadvantage is that you will not know how to manage, but you can fulfill that gap by having someone who does. And you need to make sure that you have proper advisors. To do this, you need a lot of experience and expertise on your team. You need a highly expert finance professional that has 25, 30 years of experience in doing this. You need an accounting person who's highly experienced and can see if they're lying on the financial statements or not. You need the industry expert who can tell you operationally if the business is good or not. And you need a lawyer, who can tell you whether this is a good opportunity or not. If this has legal problems, they can check all of this stuff. And if you do this analysis with these individuals, if you negotiate the price properly, if you structure the deal right, and if you have enough banks in your contact, you can raise the capital and you can acquire businesses. So that's the possibility. And you can acquire businesses that would have normally taken you 20, 25 years to create. So that's the lesson here. Starting a business versus buying a business is much better because it already exists, it already has value, it has been worked at, it has been fine-tuned, it has good employees because maybe the owner went through many employees, some employees were bad workers, he removed them, he brought in new people and they're working in the company for 10 years. Products and services were not perfect at the beginning, now they're really well. The relationship with the customers were not there. Now they have a relationship with the customer. They did not have a media presence before. Now they have a media presence. They did not have a right marketing strategy. Now they have a right marketing strategy. So everything is there. All the work is done. And all you got to do is go in, negotiate the price, raise capital and acquire. And then acquire second business, third, fourth, fifth, sixth, and it all accumulates into becoming this massive company that you can create in a few years' time, 5 to 7 years, 8 years, 9 years, but a big company that you can one day sell and gain a bunch of capital. You can pay your advisors who supported you in this venture, who was there, who believed in you. Everybody makes money. And that's the game of buying businesses. So if you like the video, and if this is something that you are inspired to do, email me. I have a mentorship program where I train you into how to position yourself. Over 3 to 6 months, I will train you into building a team, finding an industry where you can buy businesses and finding deals, negotiating, finding banks, understanding what the banks want, how they lend, on what criteria they lend on, and structuring agreements and all of those things, all the moving pieces. So if that's you, if you're inspired and if you want to take action on this, email me and we will talk further. I'll talk to you soon.